Good evening, everyone.
Hey, Daryl. Hey, were you guys able to see each other and talk to each other in the waiting room?
No.
I have got to figure out how to do that.
Oh, I didn't know that could be done.
It can be done, and even if you don't show up for your own meetup, people can have a meetup without you.
Oh.
I think the only what do I want to call it? The only way it won't happen is if you're on another call. You can, unless you have an enterprise account,
yeah,
you can only be on one Zoom call at a time, is my understanding.
Okay.
But if you weren't on the call and someone else was in the room, as long as you weren't on the Zoom call,
okay,
then they could hold the meeting without you.
Sounds good.
Evening, guys.
Good evening.
Hey, Kevin.
Hey, guys.
Hey.
Going on, GOP gang?
Hey, what's going on, James?
Hanging in there, bro. Hanging in there.
All right, all right.
Oh, I hear him, but I don't see him.
Who's that?
James, I know the voice.
That's me. That's me cleaned up. You
Uh,
don't get that too much.
do we have a presenter today, or is there a topic?
We do. Ashray's going to be presenting today.
Hi, Ashray.
And
hey guys, nice to meet you. And just to let you know, I have the two other partners in my group on the call. So the
Caleb and
Josh.
Where's Josh? Oh, okay. Yeah. Yeah. Cool.
So we're going to be doing the presentation together.
We get a triple play today. So why don't you guys each introduce yourself, because I think there's several people on the call that you may not have had a chance to talk to yet or meet. So while we're waiting for people to come in, that'd be a great opportunity to get to know each other.
Absolutely. So I'll go ahead and go first. Nice to meet you guys. Jim, I just want to say thank you for extending an invitation to let us, join the GOB group. We represent Encephalo Investments. Encephalo Investments is a investment firm that I started along with Josh and Caleb and a couple other partners about 2 years ago. We started out as a long short equity hedge fund, and as we grew and matured as a firm, we decided to, add and pivot our organization to do commercial real estate. And we've been operating in the space for about 5 months now. We currently have nothing under management, and we are looking to, start growing our portfolio over the next few months. My background is a variety of opportunities that I've been fortunate to experience. I've had experience doing buy-side investment at a hedge fund out of San Francisco. I've done corporate FP&A at Target. I'm currently getting ready to pivot into management consulting. So Encephalo is, an organization that right now is in essence, a side business. It's, 40, 50 hours a week at night. But as the firm matures and grows, it's, all of our goal is to let this become our full-time pursuit. So that's my background. I'll let Josh and Caleb introduce themselves.
Yeah, I'm Josh. Great to meet you guys. Great to connect here. Like Ashray was saying, we started the firm about a couple of years ago now. Just recently pivoted to this real estate side of things. My background, I'm currently a student at Bethel University, and I work through my internship in investment banking right now. Some of my other experience has kind of just been in the world of corporate finance. We're a pretty young group, both in terms of our ages and just kind of in terms of how old our firm is. And so really what we're just trying to do here is start to establish somewhat of a presence in the multifamily space, but we also look at assets outside of that as well. Then Caleb, if you want to take it as well.
Yeah, hi everybody. My name is Caleb. Thank you for the opportunity to be here tonight. Like Josh, I'm also a current student. I attend the University of Nebraska-Lincoln, where I am studying to be an actuary. So I do a lot of our risk assessment and work in that regard for our underwriting here at Encephalo. I'm also interning at Emeritus, which is a life insurance organization based out of Lincoln here.
So basically just three young guys ready to set the world on fire is what it boils down to.
Youth. Beautiful thing. Take
It
advantage
is
of it.
what I would give to go back.
Well, welcome, guys. Good to meet you.
Thank you.
You guys got a kind of an open floor to ask any questions or, hey, Master Sergeant.
That's a new look, David.
Hold up. Well, that's what I wanted to show you. Look what I have today.
He's in the garage.
Well, carport. It's not a garage.
Out
But,
playing with the toys.
$250.
For the hood?
Yeah, right. And she's got some rust here. You know, a little bit there. Not bad. A little bit there. A little bit under there.
What's the year?
64.
Whoops, I was about to be off by 2 years.
Yep, she's a 64.
Wow.
Where'd you find that, David?
Friend of mine. It's
Just
the power of networking.
Yeah, please come get this out of my driveway before my wife kills me kind of thing.
Well, it's been sitting in his backyard for 19 years.
There you go.
And now it's sitting in my carport. And I guarantee it'll be here another 19 years, but it'll be looking pretty and running.
That's
Got the
fantastic.
390 in it. She needs some work, but pretty clean considering.
Yeah, for that old and being sitting outside, that's awfully clean.
Yeah.
Awfully clean.
Are you going to do the work, David, or are you
Yep.
sending it to the shop?
No, I'll do the work. I got a friend coming over to take a look at it, so hang out with you guys until he gets here.
So then it is 7 after. We'll go ahead and jump right into it. I think we've got the majority of the people that are going to be here. So guys, I'll turn it over to you. Well, I need to give you screen sharing, don't I?
Yep,
There you
it
go.
should be good to go. So I'm going to go ahead and share our model. And then what I'll do is start us off with giving you guys a little bit of an overview of what we're presenting today. So today we're talking about an opportunity that we've come across in the San Antonio market. This opportunity is 3 separate properties that we're looking to bundle together as one deal. It's 204 units located in northern San Antonio in the Castle Hills and Blanco Heights neighborhoods of San Antonio. Now, San Antonio, as I'm sure many of you guys are aware of, is, the 7th largest city in the United States, 2nd largest in Texas, growing at a phenomenal rate. These properties are located about 15 minutes from downtown San Antonio and very, the neighborhoods that they're in are very safe, secure. They're close to a medical center, one of the more prominent elementary schools in the area. There are a lot of families and children running around. It's a phenomenal opportunity to invest in. Currently, the opportunity play here is a combination of vacancy and low market rents, or low rents compared to the market. And we'll dive into that a little further as we get into the property. Overall, this property, so the story behind it is it's a doctor that bought this a handful of years ago, has been trying to manage them on his own, doesn't have the experience or expertise required to handle a deal of this size. And he, in the last 6 months, decided to bring in a property manager, try to fix his vacancy issues, and he decided it's not worth the headache, and he's just looking to offload the asset. So that's the basic background for this opportunity. What we're going to do is just walk you guys through our underwriting, our assumptions, and what we're seeing on this deal. And to kick that off, I'm going to let Josh start to kind of walk you guys through a high-level overview, a 10,000-foot view of where the deal is at, what we're seeing for numbers and assumptions, and we can go from there.
Yeah, so you might have heard of this deal before. If you look at this market, It was originally issued as just Moxie and Hudson, and it was actually placed on market a few months ago. There was some initial discussion about us looking at that and just buying the first two assets, which were Moxie and Hudson, but there were a lot of competitive offers, and we didn't like the price at that. And then the broker said, hey, if you pick up the third one, we can give you a discount on the total portfolio. But at that point, they were asking for around 16 million, and it just wasn't justified to us based on what their current collections have been. A lot of that's due to COVID and the amount of vacancy they're seeing. And you'll see that we've got modeled out the economic vacancy on it and how that's kind of exploded in the last year and what our expectations are to kind of deal with that. They also have a very poor management company installed right now that's not done a great job on overseeing the asset. And as a result, they're not capturing the rents that they should be, and they're not capturing the, I think, total NOI that they want to target. So where we're kind of negotiating right now is between the $14 and $15 million price range. We think we'll finish at around 14.5. Hopefully we'll get lower than that if we decide to continue going forward on this deal. The most recent ask has been at 15.2, but we've been able to kind of wiggle down further on that. You can see that on a cap rate basis, that asking amount is a very low cap rate. And that's simply just because they're just not capturing their full potential NOI. If they were, this thing would be priced closer to, I'm guessing, a 4.5 to 4.8 cap rate. But we don't spend too much time considering the cap rates. We look at them more from a future cash flow basis. And so, yeah, if we can go into this asset at 14.5, the financing structure that we're going to put together would be through a bridge product that would give us around 75% initial loan to value on the actual down payment, and then 75 on the construction costs for renovations. We're looking at pricing it around, I think it's at about, right now we're being a little bit bearish on it, but putting 10K per unit. Half the units are at this point renovated, but we believe that there's some better renovations that can be put in there, and we want to finish up our full job on that renovation. Our asset managers put together what that Capex budget would look like. And then in addition to that, we're putting in another $1.5 million for total reserves and the actual cost of acquiring the asset. That's a somewhat bearish estimate as well on that. But that puts us in a position to raise roughly 5.6 million on this from just equity. And that's, so as you can see here, that's 31% equity put on this asset, which is pretty favorable to us from a debt to equity basis for something that would be using a syndication or a capital raising structure rather than just a single investor. And then ideally, Ashray, if you want to go to the profit and loss, you can see. And so I don't know if you fully mentioned that, but it's 204 units. And what they're capturing right now is about 2.1 million in gross rents. And so the way that we have this set up here, you can see we've got our expense escalator and our rent escalators. And then what we're looking at in terms of vacancy, and that vacancy number is economic vacancy. That's not just physical. So we calculate this together. We throw bad debt, loss to lease, concessions, and physical vacancy as just one ratio. And that's our economic vacancy. And right now they're at about 25%, which is extremely high for this location on a gross rent basis. And we think we can, by year 2, move that to around 10%. And that's, even on that, that's somewhat of a bearish estimate. And so, yeah, within that, we've got RUBS installed as well. So they're currently collecting about 118,000 through their utility reimbursement program. And we think we can grow that at a continuous scale relative to what we're seeing the competitors do. And then the other income, we've just kept flat based on where they're currently sitting. We don't want to assume that we'd capture more on that. In fact, we typically assume we'd capture less. And so you can see our effective gross income moves from about that 1.7 figure that they're currently at to around 2.7, simply because we're able to push up rents from where they're currently at, and because we're able to improve the efficiency on management. And then in addition to that, the expenses, we have the expenses continuing to grow. The biggest one is going to be kind of the tax adjustments as this thing gets reassessed. Now, it did recently get reassessed, and so it got pushed up to that 305,000 figure for their taxes, and that's jumped. I think before it was at 220,000. So that was a very large jump for them on a tax basis. And so we don't expect it to jump substantially from that point, just based on what their last statement said of what the valuation was compared to that actual locale's tax rate. And then, yeah, the year one big Capex item, and this is separate from the renovation costs, these Capex line items here. You can see the 370,000 we have at this spot. That's to replace the chiller and kind of part of their pipe system as well. They need a full replacement on that, and they've gotten quotes at around 320,000 to replace that, and we think we could do it more efficiently. But we're just assuming that worst case scenario, we'd have to spend 370,000 on that replacement. And then you can see from kind of years 1 through 5 what that cash flow means for us. Year 1, ideally, we could get our cash flow up to around 750,000 in that range, and by year 5, we could get that cash flow up to 1.2 million if we could do a 5-year hold on this. Now, we have looked at the scenario about looking at different holding periods, and we'll go over that as well. But in general, you can see here kind of what our estimates are for running this asset, just based on what we see competitors doing and what we're seeing in the area. The one thing that's really, I think, strong about this deal is that we're seeing a decent valuation with that 1% rent escalator. This market is likely to see continuous rent growth at around the 3 to 5% rate. And that's, of course, essentially more exponential the higher you grow that. We don't want to model that out. We'd rather model out closer to 1%. And typically we'd put 0, but because there is far more growth in this market that has to be considered in our actual analysis, just because of the way that assets are being priced in this area. And then we built it out on a monthly basis as well, if you go down, Ashray. But in general, for the asset, what we're seeing on a yearly basis is pretty strong, and we think that we can achievably or realistically get these numbers from just a bearish standpoint. And then if you want to go to the unit mix, Ashray, you can see kind of what we have set up right now. This is the different unit mix that they currently have for the 1-bed, 1-bath, 2-bed, 1-bath, 3-bed, 2-bath, and so on. And so on a per square foot basis, the current rents that they're capturing are quite a bit lower than what the market's doing. And a lot of those market competitors or market comps are for assets that are not renovated. We're looking at the assets that are renovated and installing what we believe we could get in rents on a post-renovation basis. And that average is about $115 per square foot, just based on what this market is. And then in addition, we're pricing in those costs you see below. Those are a balance between the partnership fees as well as just what the total cost would be to actually put together this transaction. So really what our target here is we see an asset that is currently underperforming compared to most other assets in this location. We had another deal that was just about under contract that was quite similar. It was 100 units within just miles of this property, where the rents were slightly below, but they had really good occupancy. The asset was strong, and we were ready to go on that one. And that thing was a very strong deal. The benefit to this one is that it's actually just not performing well at all right now due to the weak management. And it has a lot of deferred maintenance that we can go in and tackle with our Capex budget, in addition to installing new renovations. And that'll give us the opportunity to multiply this thing's net income substantially. And so that's what we're seeing on this. And then Ashray, if you want to flip it to kind of the exit strategies real quick, we can look at what our target is for this asset. So we'd look at kind of running a dividend recap or refinance in year 2, just based on the fact that we have a 24-month bridge loan that we'd be putting on this thing. And likely the valuations and some of the appraisals that we've seen from talking with our asset manager and others is that we could get this thing appraised closer to that market cap rate at that new NOI, if that's achievable. And that would give us a good amount to pull out of the actual asset from equity, and then install new debt on the product or on the asset with a new product. And that exit cap rate is kind of somewhat bearish. Even if you put that up to 6, the deal still holds quite well. And we're very confident in this market that they're going to continue to trade at cap rates in the 4 to 5 range. And so to add 75 basis points on that is kind of our safety net there. And we could even add up to 100 to 120 basis points, and we'd still be confident in moving forward on this. So in general here, what you can see is our plan would be to go in with that initial financing, replace that with an agency product, and then kind of move out of the asset by the 5th year. If we like how it's cash flowing, we'd continue to hold on the asset and it'd be more of a long run play, maybe a 7-year hold or an 8-year hold. But this is what we're seeing here. There's also the possibility that we could do this in 2 years and simply not refinance, but exit on the property if we have buyers that are interested, and that would yield a really strong return for us as well. But in general, this is our overall strategy. And then Ashray, if you want to go to the valuation, here's kind of what we see on the asset on a property level basis. So you can see here, we're targeting it based on an unlevered and a levered basis. We'd go in levered. I don't see this as a cash only investment. Now it could be because that's a fairly strong IRR to get for something like this on an unlevered basis without that risk. But we'd prefer to go in with that debt and kind of capture the full potential of it. And you can see that through years 2 and 3, where we kind of have interest only and strong cash flow, this thing has a great cash on cash return. But once you actually have that interest kick in, it's not as strong, but it depends really on the level of debt you want to put onto the asset, as well as what the costs look like going in. So we'd be targeting for a new buyer to be someone going in with less upfront costs who can get that higher cash on cash return and hold it for a longer period. That's typically the seller we gear towards. And from this, our IRR that we're seeing here is around 21%, though that's assuming a more favorable exit cap that we kind of ran with. And in general, we put together kind of a net present value calculation as well to just see if this thing hits kind of what we believe to be our cost of capital, which we threw at around 17.9, and our hurdle rate is at 16, just based on this market. And we've said that this asset has more risk because of both having to replace the chiller and because of the situation with COVID in San Antonio. So we've kind of increased what that cost of capital would look like to go in on this. But we're still seeing around, that 100% return from a 5-year hold. And that's what's most favorable to us without having even capturing a lot of that market rent growth. And then, I suppose if you guys want to kind of pick apart what we've said and kind of look more at the deal, or if you guys have any questions on this, we can speak more to it. And I think Ashray or Caleb, if you guys have other input to kind of throw onto our analysis here, that'd be great as well.
Yeah, I would like to ask a question.
Yeah, sure.
If you could go back to your to the rent escalator and the expense escalator. All right, thank you. As of March 2021, the United States rate of inflation is 2.6%. I see you coming in with the annual rent escalator at a 1%, and not until year 6 you bounced into 3, then it's dropping back down to a 1.6. Do you feel that maybe that's going to be a little risky with a 1% rent escalator, and our rate of inflation as of the end of March 2021 is a 2.6?
Yeah, so I'll preface that really we're not modeling anything post year 5 on this right now. We don't see a hold after year 5, and that would be something we'd review later. So you can kind of ignore the numbers after year 5 for now, because we just haven't really installed anything there that we believe is accurate. But before that period, that 1% rent, I don't see us actually seeing 1% rent growth in this market. I see us more likely witnessing closer to 3% rent growth in this market, at least for a couple of years, just based on the population trends and what the current rent trends have been. Plus everything in Texas has been quite strong right now. If you look at what just the demographic movements have been, a lot of people moving from California and New York to places like San Antonio, Austin, as well as into the state of Florida too. So that just can benefit us more so. And then to kind of the inflation point, the Feds announced that they're going to be holding rates at least at current levels till 2023. They had their meeting just the other day, and they've continued to keep rates low. The Treasury yields have ticked up recently, and that's kind of, I think, better for the debt market in total, because we're going to see less opportunity for collapse there. But from our analysis perspective, just looking at real estate, we're not as concerned with that. And we could even move our expense to escalate up to 3%, and it doesn't have a major effect.
Actually,
and if you're seeing that, you'll see the rent growth as well.
Actually, Josh, thank you very much for that answer. I just realized I reversed the two. So thank you for the answer. I just realized I reversed it. I
Yeah,
didn't-
no worries.
Thank you.
So Josh, I have a question for you. So I'm
Yep.
looking at San Antonio as well. And I just want to look at your taxes, because taxes are, in my opinion, or from what I've seen, extremely critical all over Texas, I guess. How did you come up with your year one tax number, which seemed, I mean, it's lower than your T12, but not by a lot. Usually I see a pretty big spike there. Can you talk about how you came up with your year one tax number?
Yeah, so we looked at what the broker and essentially the seller gave us for the most recent appraisal. And then we looked at that local area's current tax rate. And you put that formula together and you can develop what that tax looks like. And then assuming, and especially with the transfer of title, and I think every year in Texas, they do reappraisals on assets. And we don't expect the appraisal to jump from where it currently has been by any substantial margin. And because of that, that's where we're able to develop that tax rate.
But Josh,
How did you determine the assessment value?
We just looked at the most recent appraisal that they had, and kind of just went from there. And we don't see the taxes jumping significantly.
But Josh,
Okay.
did you go to the appraisal district or even to their site to see what the 2021 rate is and what the new assessed value is?
Yeah, we looked at what the new rate would be in this location, and then just from the county assessor's office, and identified what we're expecting taxes to be.
So just one thing I want to add. So we looked at a couple of deals now, and in all of the deals that we had a tax consultant involved, and essentially those tax consultants always blew our projects out of the water. So it would probably be just a safe bet to consult with one of those guys, because in almost all cases, taxes kill our deal. So you just want to make sure that you really get that right.
Yeah, definitely. Thank you.
Josh, what are you modeling the purchase price at?
14.5 million.
Yeah, I just ran some real quick numbers. I think that, I mean, obviously I would agree with what Bastian said, that, and what Daryl said, you want to check with local tax authorities. And if you have someone who does, if you have some contacts who do the tax evaluations each year, that reach out to them. But if you're using 80% of purchase price at the millage rate for San Antonio, it actually comes in right at what the T12 number is. So and the fact that, Bastian, I think right before you got on, that Ashray had said that they had just been reassessed, I think last year, and so I think they stand a good chance of year one. I think that's probably a pretty accurate number and pretty conservative, but that's just my opinion. I'd definitely double check it. But I had a quick question about how many properties was this in the package?
It's
3 properties.
204 units total.
And how far apart are they from each other?
So Moxie and Hudson are a little over 0.78 miles apart. I think that's the exact number. And then Trio is 2/3 of a mile from the pairing.
And you're looking at replacing chiller at all properties?
No, the chiller system is only in Trio, and it's only in 2 of the 3. So if we think about each of the buildings, Moxie has four buildings, Hudson has 8, and Trio has 3. And Trio is the only property that has a chiller system. And the chiller system is only in 2 of the 3 buildings. Trio has 100 units, and the chiller system impacts 77 of them.
Okay. did you guys did you have someone quote that, or you're just taking the quote estimate from the seller?
So
replacement
the seller has gotten quotes for about $340,000 to $350,000 for replacement of the chiller system. In conversations with our asset manager down in San Antonio, he felt pretty confident that we'd be able to get the entire system replaced for around $280,000.
Yeah.
But from a bear case, if you guys haven't picked up on everything we're modeling, we're trying to go absolute bear case.
Yeah.
And if worst case scenario, this deal meets our hurdle, then it looks appetizing to us. So that's what we're baking in, the $370,000 in year one Capex.
And what are you on that model replacing, Ashray? Is that, I know you said the boiler, chiller, the water tower. What is it?
Some of the Capex
anything?
some of the Capex is also built in to replace the piping. These are really old properties, all built in the 60s. And so they have galvanized piping. And as we've recently seen, right, Texas underwent a deep freeze, which is going to completely screw up your piping. And so we're kind of planning in a little bit of that expense for the near future.
Okay.
Yeah.
All right,
And
cool.
from a replacement schedule perspective, we're anticipating to replace somewhere between 7 to 10% of the piping every year. And because of the way the piping is set up in Texas, they're able to go in and do piecemeal replacements. And that comes out to around $150 a foot of piping. So we're anticipating, worst case scenario, we're gonna have to go in and do those replacements, and we're baking that into our model. But realistically, in our conversations, Caleb, do you remember exactly? It was somewhere close to 30 or 35% of the piping has already been replaced over the last 5 years.
I don't recall the percentage that's been replaced. All I know is they've put $70,000 over the last 5 years into the piping. Yeah.
Yep. And we're anticipating that over the next 5 years, the percentage of piping that's going to need to be replaced, we're anticipating a much higher number than what we were actually modeling out. But realistically, we don't anticipate having to replace more than a quarter of the remaining piping.
And what did you guys model in for loan cost? Closing cost?
You say loan costs?
535,000 for closing.
535?
And
Okay.
Cost, right? Unit mixing costs.
Okay.
yeah, origination fees around 124,000 from what we
Okay.
got quoted.
All right, let's see here.
And some of these numbers are overinflated.
Okay.
Others we haven't thrown in there yet.
So I was just checking real quick, and I'm literally blind. So did you guys model in for a cap rate policy?
What do you mean?
A capping your interest rate on the bridge?
Yeah.
Cap rate
included that.
escalator policy? So,
Yeah.
Okay.
Did you guys test out if you cannot refinance in year 2 or 3 and you have to hold and add on like additional years to the bridge, how would the deal pencil out? Would that still work?
The group that we would be facilitating the bridge through also does agency, and they line it up back to back. So they will be originating a new product, whether it's an agency product or an alternative loan product that doesn't replicate bridge, but is essentially an alternative agency. They would be lining that up within 5 to 6 months prior to actually the terminal date on the bridge loan. And so for us, we kind of have that guarantee that we would be out of the bridge position. But if we have to go in on that non-agency, but agency alternative product, it wouldn't be as favorable, but only by about 50 basis points or so on the interest rate. And that has a very marginal effect on the total property's return.
What did you model the interest rate on after the refi?
We got quoted at around 4 is what they said we could get around. Now,
Okay.
that's
And does your model? And by the way, which model are you guys using?
This is one we built.
this is one we built.
Okay. So you have refi built into the model, or you're just blending the two?
It's an option.
Yeah.
Modifier. Mhm.
Yeah, we have a multi-loan
Okay.
debt page.
Okay.
I can't recall why, you had like a vacancy rate of about 25%. And I can't recall, why it was that high. I know there was a portion of it that's economic.
The 25% vacancy ratio there is actually the T12 vacancy. So that's currently what they're experiencing right now.
On total economic vacancy too.
So
So-
what are the reasons for it being that high?
Right now they can't, or right now part of it is the management companies failed to actually advertise the assets effectively and bring in new tenants. Part of it is that there's currently tenants that aren't paying rent and are protected by San Antonio and kind of the state of Texas. And then the other part of that is that they have such significant loss to lease, and they've also been experiencing kind of a period where, I mean, they've been collecting a lot of bad debt simply because of COVID. And that's kind of what's pushed that pretty high. And so we expect that we can kind of taper that off in this first year of holding the asset. And that's in line with kind of everything that property managers and asset managers have told us about what that would be like if we go in and were to acquire this.
Who's
What's the actual-
managing it? Who's managing the property right now, guys?
Well, it's been a mix. The doctor that currently owns the asset, he managed it himself for a period, and then he's brought in multiple different property managers. We're not up to date with who the current one is now. And that's definitely something we should get more up to date with, but we're not in line exactly with who the current property manager is. I think the property manager that was on it before actually I don't remember if they went bankrupt or they just disappeared.
They went under.
But-
So basically what happened is
Yeah.
this doctor 1031 into these properties about 3 years ago, and was self-managing all of them up until September or October of 2020. And within that time frame, he's gone through 3 property management companies. I mean, we were originally looking at this opportunity in January, and between January and now, they've changed property managers again.
Wow.
So for self-managing an asset of this size while being a full-time practicing physician is just not possible. I mean, I don't want to say it's not possible. Everything's possible, but he wasn't doing a good job. The property managers are struggling to come in. These same property managers are the brokers selling another deal in Austin, and they're the same property management group is on that property, and that property is sitting at 23-24% vacancy. So they across the board they're not strong property managers.
Who are you guys modeling to take over?
So we've looked at a couple opportunities, and in our conversations, our strongest option right now in the San Antonio market is going to be either using Simpson Multifamily Group or it's going to be using Topaz Property Management.
We also spoke with Elmington, and we really liked one of the reps from Elmington. They were just uncertain if they wanted to expand into something like this. We were talking with them on another asset, and because this one's about double the size of that other asset, that might pull them to be more interested on this. We really like the rep that we worked with on that, and we'd love to be able to work with her. So yeah, we've got a number of different management companies that we'd be picking between, and we'd have Simpson operating as our asset manager, regardless of who the property manager is.
So what do those costs look like? How did you model those costs?
So across the board, the property managers have been pretty consistent, saying 3.5% of revenues is going to be their fee. Asset management, Josh, do you remember what Simpson's fee is?
Simpson collects a number of different ways. He gives you a number of different payment opportunities, and some of those are negotiated at property level. Some of those are negotiated to a firm if he's working with the firm. So we can structure that a variety of different ways, but you can see we're basically having a pretty significant increase in the level of property management costs we'd have versus what they're currently paying. And that's, I don't know how they're paying that amount and receiving the services they're receiving.
So are you modeling for extra help during the lease up and trying to get the property stabilized?
Yeah, as you can see from our T12 to our year one, we have a jump in payroll from about 93,000 to 200,000. That's the estimates we've got from the contacts we have down there.
Josh, have you spoken with the lender in reference to how they put their capital expenditures, whether if it's above the NOI or below the NOI?
Yeah, with it being a bridge product,
Yeah.
we've got what we can classify as our capital expenditure budget. On here, our model, we separate our property level capital expenditures from our construction costs. So these capital expenditures are pulled directly from our operating reserves, which is equity that we raise, versus our actual construction cost budget is what we would receive financing for. And when they model, when lenders are going to size this up, they're going to look at capital expenditures as a post net operating income, because it's not considered an operating line item. It's considered a non-operating line item. So that's how they would typically size it up. And then they can look at cash flow. And so the debt coverage would come from our cash flow from operations, which would be net of the capital expenditures.
Okay, so your lender will have it below the NOI.
Yeah.
Okay.
And they'll look at the cash flow item more than they'll look at NOI typically for us, because they want to ensure solvency.
And just for sake of transparency, we're most likely going to be getting our lending through Eastern Union and Arbor. So that's going to be the groups we're going to be using.
Yeah, Michael Wine at Eastern Union, we can't recommend him enough. He's a fantastic kind of capital markets guy to work with. He really works with clients quite well. And so definitely recommend. I know Old Capital has some affiliation and they've got great things as well. And so there's a lot of different people on the capital markets side that are fantastic to work with here. Yeah, and then I know that there's also capital markets groups that do equity financing as well. They typically look at larger deals, and most of them focus more towards development. But they're also something that can be pulled into consideration on transactions like this, if this were maybe a bit bigger, closer to 400 units. But yeah, for our equity financing, we're going to go down kind of the route of us raising the capital or working with capital raisers that we can identify.
So for this opportunity, oh, go ahead, Daryl.
Now I was going to ask, could you switch back to the returns? Okay, thank you.
So for this opportunity, we've been in talks with the brokers. We have a LOI out at 14 million. They're seeking closer to 15. So we're trying to, the brokers is somebody, we've worked closely with in the past, and they feel confident that we should be able to meet somewhere halfway. And that's where we're modeling an acquisition price of 14 and a half. We should know whether or not, this deal is a go from a contract perspective sometime late next week. So for this, where it boils down to is, we hope, you guys can pick apart, and we're happy to have had you guys pick apart everything we're seeing. And at the end of the day, from here, the movement is, we need to raise a little over $5.5 million and execute on an opportunity in San Antonio.
Okay. And you said the LOI is for 14 million or 14 and a half?
14.
14.
Yeah.
Can you go to the page where the price is? I guess that'd be your summary.
Yeah, we're modeling that will end up at 14 and a half.
Okay, good.
But right now we're negotiating at 14.
Okay.
So 14 and a half is your best and final offer, I guess?
That would be what we'd be willing to go up to.
Gotcha.
And I see your equity split is going to be a 3160 now, or is,
Yep.
That's just the debt to equity split.
so is there going to be a pref on this?
Sorry, can you say that again?
Will there be a pref on this?
Yeah, Ashray, if you want to go to the waterfall, here's kind of our distribution structure. And we're actually probably going to target the preferred to 16 on the second hurdle. This would be, and you can see it kind of at the property level versus what the distributions look like. and we're not really sitting on this right now.
Okay,
Like what we have for our preferred structure is not finalized. We consider that more when we're actually in the capital raising process. For us, we're concerned about property level right now. That's the key function for us when it comes to actually working through the deal on a transaction basis. That's where we can restructure that, and we'd probably look more towards a 20-80 split on the second hurdle that we put.
thank you.
So based on everything we've shown you guys today, what I always like to ask both in opportunities like this and interviews, et cetera, is just for feedback, anywhere from, just the visual of what we've presented to how we've put everything together in the model to, the numbers and assumptions we're using, through what we're modeling for, return perspective. If you guys could provide any feedback across, those categories, I would appreciate that.
Being someone who's not as familiar with the Houston area in particular, I think it's helpful. There's other people who've made presentations that give us a little bit of background about the market, so we get a little bit of what the market analysis is. Because realistically, I don't think you guys have shown us anything about, I know what the total rent you're collecting, but you're not telling us anything about, or at least I didn't see, that, for example, you're collecting $700 on 2 bedrooms and the market rent is $775 or something like that. So one thing that would make this stronger for potential investors is to see what the market's offering, what the property's offering, so I can see very easier where the potential values are or weaknesses.
Yeah, absolutely. Give me 1 second. Let me pull up a quick.
I actually,
You have it already?
I have it. Yeah, if I go into present mode,
So I'll stop sharing my screen.
this should be able to do it. Yeah. Let me pull it up, share screen.
And then Caleb, I'll just let you talk through everything.
Yeah, so this is from a pitch deck for one of those different opportunities that Josh was describing earlier that we had. Oh, whoops, back in this way, back in January. So this is just kind of a key demographic of the San Antonio area. As we can see, a little under 2 million people, but that's been growing pretty steadily. Solid disposable income, which is absolutely fantastic. Graduation rates are not premium for the US, but they're doing all right. Overall, let me move this out the way on my side. And then employment, mostly a majority white collar, but then a decent amount of blue collar and blue job services jobs. This 10.1% unemployment rate, this was created during COVID, and so that's very boosted right now, at least in this document when it was created. And so I'd expect that to be a lot lower at the moment. And then the next page, if I click through, should have a couple key economic drivers. So USAA headquarters. By the way, just if you can see my mouse, we're up here, right? This is where the property is. So these 1, 2, 3, all within a relatively close area. The USAA headquarters, that is like the main employment center for all of San Antonio. That's where a majority of the population does work. We also have the San Antonio University Health System, and then the North Star Mall, which is more towards the downtown area of San Antonio. When we were down there touring a property, we stopped by there, and it's a very nice premium area. And so we feel very confident in the future economic growth of the city.
So
And just to give insight, the property is the set of properties are just to the left of the arrow on the number 2, and very close to even closer, Caleb. Yeah, right around there.
So to Raymond's point, guys, on your rents, I know you had a very conservative number of 1%. But what we didn't look at or see, or at least it might have been when I stepped away to the restroom, did you talk about in-place rents and comps and what the comps look like within a mile radius, what the median income is within a mile radius?
Yeah, absolutely. I can speak to that a little bit. So we did a combination of looking at both the broker provided comps and their OMs across the various properties in the area. And all the provided comps were for non-renovated units in the same area. And we have in our model that as the market rents. And then what we did was, we just went through and we did our own analysis, and we were looking at a variety of sources, apartments.com, Zillow, et cetera, and looking at, excuse me, sorry. And we were looking at I was focused on the exact square footage range that, each set of, units were at, the 1 bed, 1 bath, 2 bed, 1 bath, et cetera. And for properties in the exact neighborhood we were looking in, whether it was Castle Hills or Blanco Heights. And in that area, I was looking at, I was looking at the range of the rents. So as an example, let's say there was a comparable post-renovated property that the rent for a 1 bed, 1 bath was $1,100 to $1,150 for a unit. In our post-reno values, we were putting in, $1,050. Again, taking the absolute bear case and going below market for post-reno. And we did that across the board for all of the unit mix.
So that's a great answer, Ashray. I would, if I were trying to pitch this in a pitch deck or in a webinar, I would definitely want to see those numbers and be able to visualize what you just said.
Absolutely. I appreciate that. Now, based off of everything else that we've presented, both from the valuation perspective and from, the market perspective, based on the returns that we've showcased, where do you guys sit? What do you think? Do you think that our underwriting is making sense, that what we're seeing makes sense? Or do you guys feel like we're missing something, or that our valuation is too bullish, et cetera?
Well, we didn't dig really deep into your expense numbers, and we didn't dig real deep into the comparables for rent comps. I know that you hit it right now on a high level, but to really answer that question, I think we'd want to dig in and look at those two items a lot closer. On a high level, everything looks outstanding. But the detail behind those numbers is the true telltale sign.
Absolutely.
I think a lot of it is going to be contingent on getting the right property manager in there. It seems like this place has been lacking that for a while.
Another
and
detail that
and
I
did
didn't
your
pitch was what upgrades are you making? Because you said some of the renovations have been done. I don't know. I think it was 35%, but you said you didn't like them, and we don't know what are the details of that. Flooring, cabinets, I don't know, whatever it is.
Caleb, since we're on the deck, do you mind flipping back to slides like 12 and 13 where we have images of the property?
Oh, this is Glenwood, Asher. This isn't, I told you, this isn't the.
Oh, here.
I didn't have.
Let me do.
Pulled up. Yeah. If you
Give
want to pull that
me-
up, we can do that. Mhm.
Yeah.
I'll stop that share for the moment. If you're not there yet, I have it.
You have it?
Yeah. I can.
Yeah, I would appreciate it.
You want me to show it? Okay.
Yeah, did you?
Yeah, I got you. Okay, so minimize that. Here we have the Moxie. This one has been slightly more Reno than the others, as you can see. Very nice flooring, relatively nice countertops. Cabinets could definitely still use some work, but some Capex has been put in. Same with the bathrooms. You can tell they kind of did those at the same time. In terms of the exterior, not a ton has been done. Maybe a fresh coat of paint, but seeing it with our own eyes would probably help determine that a little bit better. And then some of the outdoor Capex would go on, redoing these parking lot kind of awnings. They clearly seem to be a little bit aged. Moving on here, now we have the Hudson. This is one that a little more significant Capex would go into. Flooring's been replaced, which is great, but better appliances, better countertops and cabinets. That's kind of the angle we'd attack this one from. Once again, this bathroom looks a little bit better than the kitchens, but still some work to be done. And then the last one is the Trio, which these are the Renos that we don't really like. As you can see, they put in new flooring and they put in new countertops, but the designs of the kitchen are weird. They didn't really move much in terms of the cabinets or appliances. And so that's another area we'd like to improve. Mostly kitchen renovations, and then some of the bathrooms, improving light fixtures, faucets, things like that.
And I was down visiting these properties about 2 months ago, and across the board, it's just going to be really coming in and making sure that the renovation that has been done with quality. While we were touring some of the renovated units, I was going through playing with the cabinets, playing with the fixtures, and they were very high level jobs. They weren't done with care or with quality. So it would be going in and having people stress test everything, going through making sure stuff's cleaned up properly. So that's going to be where the majority of the Capex budget is going for the interior renovations.
How much do you guys budget for Capex per unit?
We're budgeting 10,000 a unit right now.
Is that exterior and interior, or only interior?
That is
It's a
both.
blend. That's a blend. We have it's a matter of what we can get qualified from the lender, and so anything that we can get qualified, we've thrown into our Capex budget, into our construction cost budget, and that's at around 2 million. And then the remaining amount would be raised through just the operating reserves that we've pulled, which with some of that money we'd plow that into other items, and that would just be from the equity we raise.
How much did you put in for your operating reserves? 1 month, 2 month, 6 months?
So we raised around 1 million, which that covers our debt service for around 2 years if we were to go with that fully. So that would cover full debt service for 2 years. And we can raise that number or lower that number. We think 1 million is kind of the optimal amount, and without having to cover certain parts of our debt service. And if we can get that actually just covered from the revenue on the property, we'd like to plow the rest of that back into it.
Hey guys, what's the schedule like to complete all the reno that you have to do?
So based off the conversations we've had with Daniel Simpson, our asset manager, and then Kira, our contact at Elmington, she said at each of these properties, it could be around a 6 to 9 month renovation. If we move quickly, it could be closer to a year if things are going slowly and we're trying to make sure that we stay as leased up as possible and not take huge vacancy hits. But that's why we're kind of factoring in that 15 to 20% vacancy year one for all of the different empty units we'd have to do so we could actually fix them up.
So then where does the jump in revenue come from for the first year? Because I think it's like 600,000 or 700,000 increase in the first year.
So in the first year, we have potential rent jumping around that value. So like maximal, if everything was renoed, if we could lease everything fully to the maximal values for the market and the post-reno rents, but then we take away from that value based on what's actually going to happen. So that's where that economic vacancy comes into play.
Did you guys run all your numbers by your property manager yet? Did you show them your underwriting and kind of your scope of work and what your intentions are?
Yep, with the different property managers we've spoken with, we've walked them through kind of what our plan would be and what the expectations would be on that. And most of them think we're too bearish when it comes to the rents, and they've had, like, we've had some disagreement with regards to what the process would be in terms of actually implementing the renovations, because some property managers we spoke with said that we could get the renos done very quickly and think that it would actually be a waste to put some of the renovations in that we want to do. But our goal is to make this thing a strong enough property that it doesn't need anything significant from a Capex basis 5 years from now. And our goal is to really make this thing a strong cash flow opportunity for the next buyer. And kind of with that, some of the property managers think that we've been targeting more of that cash flow perspective, but with the ones that we would actually pursue the deal with, they're in full agreement on what our procedures are, and they actually think that, and their numbers, they're more optimistic on things, which is really a good sign to us. And we're happy to see that, but we've seen too many deals go the wrong direction that we don't want to always listen to that.
Yeah, both from a from a renovation perspective and Capex perspective, our values are what were provided by our asset manager, and then we inflated them further just again to be as bearish as possible and make sure this deal stands on its own.
Sorry, guys, can you just say again the number of units and how many are actually vacant, the physical vacancy? I don't recall what you said.
So it's 204 units. Actual vacant. Caleb, you might have that pulled up.
So I know off the top of my head that the Hudson is sitting at 77% occupied. Moxie is sitting at 86% occupied. I honestly don't recall Trio off the top.
Trio is at 77. Hudson's at 92. Moxie's at 84.
Are those the updated numbers?
Those are the updated numbers.
Gotcha. Yep.
So across the board, that's 77 units plus another.
And then Trio is a significantly larger portion of the portfolio. It's about half the units, and so that 76 or 77% number for the Trio is going to definitely weigh down the average, and that's why we're talking so much about this vacancy play.
Yeah, so across the board, it's roughly, and I don't have the exact numbers pulled up in front of me, but it's roughly 160 units are leased up right now out of the 204.
160. Okay, thank you.
Kevin,
Yeah.
go back to your question again about the vacancies and the what you just mentioned, because with that high vacancy, go ahead.
Exactly. The timing of it, it
Uh-huh.
kind of seems a little bit off that the rents will jump that much in the first year. And also with a 6 to 9 month rental period per property, right? I think that's what they said. Yeah, it doesn't seem that a revenue could reach that much that quickly, because they'll also have to consider the lease periods for the current tenants and when that's expiring, and if it is that can be increased as well to the market rates that they're looking for.
So
Yeah,
guys,
and-
let me interject real quick before you answer. Daryl, I need to make you host or co-host if you can. I'm going to have to step away, and I want you guys to be able to continue on.
Okay.
Thank you for your time, Jim. Appreciate it.
Thanks, guys.
Okay, Jim.
Thank you, Jim.
Whoops.
Yeah, I have to jump too, guys, but I think you guys did an excellent presentation, and it sounds like you're on the right path with this. So best of luck with it.
Thank you.
Yeah, and so kind of to that point, well, the way that we've modeled this is that rent jump that you're seeing from 2.1 million, what they're currently set at, to 2.5, which is what we've modeled at for year one. That's just simply what the potential market rents would be for the asset following the renovations, and then we deduct from that heavily, as kind of Caleb was saying, we deduct from that and kind of develop what we'd actually see our economic vacancy to look like. And that's where that loss to lease figure comes in, where, yeah, we're not going to have the renos available throughout the whole year. We're not going to have all of our, or we're not going to have all the units leased up to the market rate that we want to achieve. And so as a result, we're modeling that year one vacancy ratio to be higher. And kind of as a result, that's typically what is really going to deduct from that gross rent figure. And you can see that that number, they're currently at 530,000. We think we can bring that down to 511,000. And then you can see in year two, that drops in half because of the efficiency we improve upon on the asset. And we can actually start to lease it up to the levels that we want to achieve and kind of get most of the units filled out. So that's kind of how I can answer that question.
Thank you.
Before we go, I just want to say, you guys are all under 25, I think. You guys are killers. You speak well, you got big balls, and you're going to do it. Whether it's this property or not, I love you. Or maybe I'm envious of you. Maybe that's what it is. But, and regardless of what happens with this, don't be discouraged. You're gonna kill it. And
Thank you, Raymond.
And whatever you learn, keep going. Because my kid's 19, and man, I don't see that my son getting this good in even 10 years. Forget 5. You guys are killers.
Thank you, Raymond. From a next steps perspective, I'll probably be sending in the next today's Thursday. In the next 5 to 6 days, I'll be posting a link in the GOB Slack channel for a webinar. Once we learn more late next week regarding our position and whether or not our LOI is accepted, for a formal webinar surrounding this opportunity. At that point, we'll be, running through everything we've talked through here today. To Jim's point, having, more in-depth opportunities for conversation regarding both comps and, other valuation metrics that we're looking at. And from there, it's going to be, moving to just tackle this, and hopefully, we're able to do this with some of you guys. I feel very fortunate that David reached out to me to give us the opportunity to be part of this platform. And I really want to be able to contribute in any way we can.
One thing for your future presentation, I think Kevin's point is very important, is if it's going to take 9 months and probably maybe more realistically 12 months to do the renovations, you really might, I don't see logically speaking, how you're going to have that much of a rent bump. That's hard to see, and maybe it'll be easier to see when you're talking a little bit of the details of, because we still don't know how much a 2-bedroom is getting at each facility.
Yep.
Building. And so that will be the key to tying up your story. Without that, your story is just, we're taking it at face value. You don't have numbers for that to show it. And without that, you're going to have a problem for getting potential investors is probably the thing I see. And
No, that's a very valid point. And we have some of those numbers in the model, just clearly the presentation isn't quite there yet for you to be able to see it and understand it exactly. And so that's something we will definitely work on to give you that information in the future. Yeah.
Your presentation today, were you, for your presentation today, were you doing this presentation to grab investors, or were you doing this presentation to the GOB members to show them what you have, where you're going, and what you have been? Because it sounded like to me, the presentation wasn't necessarily for the webinar, because I know when that webinar comes, y'all gonna be ready, y'all gonna be kicking butt. So it sounded like to me today you wanted to bring this information to us to get feedback. And then for that webinar, you're gonna kick the feedback in it, and it's gonna shine like gravy. Am I right?
Daryl, you hit the nail on the head. That's the goal. Today was we wanted to flesh it out, but at the same time, if there's anybody that's interested, we'd love to start talking. But no, today's goal was purely we wanted to see where everyone's head's at, make sure that we're coming at this with the right approach. We're young, we're new to this. We want to make sure that everything that we've learned so far, we've learned correctly, and from there, do a formal webinar and actually raise capital.
Hey, I got a quick question, just out of curiosity. How many deals have you guys done?
Josh,
Yeah, so at this point, this is our like first that we would actually go through and acquire. We've had a number that have gotten close through kind of the purchase process, but they've never been able to fully work out. And a lot of that was just, we didn't at that point understand really what the process was like. And we've been lucky to have one of my professors actually here at Bethel University. He's got a portfolio of around 3,000, I think now 3.5 thousand units of multifamily, mostly in Memphis. His name's Drew Whitson, and he's kind of been our lead. He's been our lead mentor and guide on everything. So he's one of my professors, and I have a class with him twice a week. And outside of class, he teaches us how to do this and shows us the process here. And actually, he's wanted to partner with us on deals when he can. So that's been the thing for us, is mostly learning what we're doing here, and also just kind of establishing what our position is, especially with our age. We've definitely struggled to at first get taken seriously with what we've been trying to do. But really, we've been very fortunate to have a lot of people, especially like you guys, just give us feedback and help us out when it comes to things like this. So we're very grateful for that.
That's cool. I am envious that you get to be in Drew Whitson's class when you are, and that seems like it's a more useful tuition payment, I guess, more or less. And Bethel, yeah, I'm a big fan of their basketball coach. I was a basketball coach, and yeah, I followed them a lot. Yeah, that's cool.
I got a question. What kind of stress testing have you done on your model?
And do you mean on the deal itself, or do you mean
on the deal
model
itself? Like
Okay.
in terms of what if you have no rent increases and you lose an extra 5% vacancy over the next year?
Yeah, through running our scenarios. And right now, this is if we can get operations going the way we want, these are our bearish numbers. If operations don't go well and we get these bearish numbers, the deal is not as strong then, right? We're looking at closer to that 10 to 12% IRR. And we also have kind of in our contingency when it comes to investing, right? We invest pari passu, but we've set it up that, right, we have preferred returns. So anything that we can get at that preferred level, that automatically goes to our investors. And then if we just happen to do well with the deal, that's where it goes to the sponsors on the transaction. But yeah, in terms of stress testing it's really about targeting when we would exit. And if we don't see it as favorable, we look at more of a near-term exit than a longer-term hold. But at the same time, I mean, it really depends on which drivers we're not seeing success on. So if we're not able to get this thing leased up the way we'd like, that's something where we'd look to sell as an opportunity for somebody else to come in and attempt that. Otherwise, if we're able to get it leased up, but maybe the operational process of putting together those renovations takes longer, we might actually just extend our holding period to capture more of that strong cash flow in the later years. So that's kind of what our stress testings look like in the scenarios that we've built out in our analysis.
Okay. And with the current rents and current occupancy, if these properties are at around 77%, what is really the break-even occupancy that you need from that 77% to pay all the bills?
Yeah, from that 77, we would need, without deducting from our operating reserves, right? So if you just look at the property itself, we would need to get up to around 82 to 84% occupancy. It depends on where that occupancy is sitting and if that's leaning more towards Moxie and Hudson or if that's on the Trio asset. But if we can get to that 82 to 84% range, that's where we can break even and cover all the bills on the asset, including the debt service. Outside of the debt service, this thing will break even and get a solid NOI even at 68% occupancy. And so for us, yeah, it's a matter of if we can cover that debt service, and that's where we bring in that $1 million of operating reserves.
Okay. And did you guys look into what is Section 8? Are there units that are rented to Section 8? And if there are, is that the current market rate? Because Section 8 sometimes pays more than market rate.
Caleb, do you remember if there were any Section 8?
Honestly, I think there were, but I don't remember how many off the top of my
It
head.
was not a substantial portion.
Yeah, significant impact.
And so the rent rolls we've received from the seller, they've been a mixed bag. Some of them, I mean, there's been some interesting changes there. And so auditing the rent rolls has been a process. But what we see is not a lot of Section 8, and the payments on those are below what that current rate actually is. So they're not even capturing solid on the Section 8s that they do have. Like there were ones where we had units that people were paying $200 a month for. And I think those were on the earlier rent rolls we saw from November. I don't know how those have adjusted as of April 2021, but that's just an example of the inefficiency.
Based on my conversation with both the broker over the phone and while I was down visiting the property and talking to the property manager, less than 3% of the units are Section 8 currently.
Okay.
Yeah, I'm looking at the rent rolls. I'm counting around maybe 5 to 6 just through a quick scan.
So the reason I'm just bringing that up is because if COVID is still a problem, I'm going to say in 6 months from now, sometimes secure rent is potentially Section 8 tenants in this type of environment. But if it's not market rent, well, then it doesn't really justify that. But if you have 25% vacancy, you may want to bring some of those in. Okay, thanks.
Yeah, thank you for that. That's good to know.
Excellent job, fellas. Excellent job.
Thank you.
Any other questions? All right.
If not, hopefully we see many familiar faces on our webinar sometime next week or the week after. And if anybody has any follow-up questions or wants to learn more about this opportunity, feel free to shoot me a message on Slack. I think Josh is in the Slack group if you have any more specific questions for him. What I will do is right now, I'll toss all 3 of our emails into the chat. That way, if anybody wants to follow up and learn more about this opportunity, they can.
Fantastic.
Otherwise, again, thank you guys for your time today. We really appreciate being able to present to you guys.
Thank you. Excellent job.
Thank you.
All right. If there's no further questions, then we'll go ahead and call it a night.
Awesome. Have a great night,
All
everybody.
right. Thank you, everyone. Have a great night.
You guys have a great night.